You as a real estate professional need leads to grow your business. ICIWorld.com is proud to present our action-packed seminar, How to Generate Leads Utilizing the Power of the Internet. Do you have widgets on your website that generate you leads? This seminar will show you widgets that not only generate leads but deals as well. Are you ready for the mobile revolution? We will show you how to prepare your business to reach the over 7 billion mobile devices now on the planet. We will show you where you can post your pocket listings and real estate information for viewing by thousands instantly. Join us for an educational, entertaining seminar that will help you grow your business. We've been doing these seminars for over 19 years globally to real estate boards, organizations, and real estate offices. Our presenters are all current and former real estate brokers who teach all agents how to generate more leads. For more information, please visit ICIWorld.com and click on seminars. We look forward to meeting with you. Have a great day.
Good morning, everyone. My name is Greg Harris, and I'm the 2013 president of the CCIM Central Canada chapter. And welcome to our breakfast seminar today. It's a joint event held with the TREB commercial division, and Don Patterson is here, and we'll say a few words.
Thanks very much, and I'm delighted to kick off this morning. I wanted just to say a few words. I'm the vice chair of TREB Commercial. I've been in the commercial business for some 35 years, primarily on the commercial side. I'm also a lawyer by profession, though I tell people I do have good qualities about me as well. Actually, I was teaching a course out in Peterborough last year, and my idea is always to get the message across of how can we do more deals and put them together. And one of the participants came up to me afterwards and he said, "Now, Mr. Patterson, I know you're a lawyer, but that was actually helpful." I wanted to take just a few minutes and talk about the importance of professionalism, continuing education, and making more deals so we can make more money. Continuing to raise the bar is so important, and so the training that you're taking will help tremendously in that. And I encourage people to take every opportunity that you can in that regard. I was at the real estate forum yesterday, and one of the speakers was talking about the advantages that we have in the GTA. And you think of we really have a tremendous advantage in Canada and the GTA here. Immigration, I've looked at those numbers. 25 years ago, most of the immigrants coming into Canada were on the family or the refugee class. Now most of them are on the economic immigrant category. Of 250,000 immigrants coming into the GTA every year, coming to Canada, 75,000 coming into the GTA. And being in that economic immigrant category, they've got job skills, they've got money to invest. And so you think of the opportunities that we have as far as selling them houses, finding commercial investments for them as well. And one of the key aspects that you have is you have that trust with your clients. And so if they're coming to you looking to buy a house, and you also have the skill set to say, yes, I can help you with a commercial investment as well. Provide that proper knowledge, but have that expertise. And one of the tips I would suggest to you is that you may not have an expertise in every single commercial area, but partner with people who have that expertise. So maybe you know somebody on the apartment side or on the industrial or finding that plaza that nobody can find. Well, contact them and share the pie in that regard and build those relationships. Because again, the trust side is so important for your client, but also for the other realtors that you're working with. One other comment I wanted to make is positioning yourself by continually raising the bar and becoming the real estate provider for your client. Much of my career has been on the corporate side. I was with TD Bank for 15 years. I was with the Ontario government as well. And I wanted to give you one brief example. When I started with TD back in '88, I came in and all the real estate was being done at the local level. So the new branch acquisitions, the leasing, the construction might have been done by the branch manager or the loans officer. Well, it doesn't really make sense, right? So I did a bit of a study there, and the average rent paid for new branches that were being opened, rent paid before they actually opened, was 13 months. Doesn't make a whole lot of sense, because really when you're working for your client, you want to have that branch or that business open on the day that you start paying rent. So we did one test case in Ontario Southwest, and it's not rocket science, but we had a lease administration team. We had a great group of lease managers. We put it together, and presto, what ended up happening was that the rents dropped. We eliminated the rent before opening, and then eventually we rolled it out and across the country. Now, what that allowed the branch managers and the loans officers to do was to get back to their core business, which is banking. And that's what you want to position yourself with the additional knowledge, with the networking, with the expertise that you can provide to your clients. You want to be their trusted real estate advisor. Thank you.
Thanks, Don. Again, my name is Greg Harris. I work for CBRE Limited out of London, Ontario. And just quickly give you a brief rundown of CCIM in case you're not familiar. Obviously, this is our agenda today. We will have period for questions after Frank's presentation, and there'll also be a little networking break where you can talk with your fellow attendees. Afterwards, there will be the annual general meeting of the CCIM Central Canada chapter. So if you're a chapter member, please hang around, and we'll be providing an update of chapter activities over the last year. So what is the CCIM? CCIM is a certified commercial investment member. It's a recognized expert in the disciplines of commercial real estate and an invaluable resource to the commercial real estate owner, investor, and user. This is just a breakdown from the Institute in Chicago of the different streams where our CCIM members come from. Large percentage is agent and broker, and then investments, but there's all kinds of different levels. There's corporate real estate executives, property managers, consultants, developers, etc. So you can see it's a pretty broad range of professionals that hold the CCIM designation. Only 6% of the 150,000 estimated commercial real estate practitioners in North America hold the CCIM designation. It does require some extensive study, and you also have to prove your experience. In order to earn the CCM designation, you must pass 4 designation core courses. There's a negotiations course as well, and then there's 2 elective credits that you must achieve also, as well as submitting a portfolio of qualifying experience. And finally, there is a comprehensive exam that's offered twice a year at the CCM business meetings in the spring and the fall. Just overview of the core courses. CI 101, which is the course you're required to take first, is Intro to Financial Analysis, which talks about cash flow, decision-making models, and measuring the impact of taxation and financial leverage on cash flow. 102 is more of a market analysis course, applying analysis with demographics, site location studies, and it involves the use of geographic information systems and geospatial information to help analyze location. User decision analysis, we just ran this course last week at Ryerson. This is designed to maximize outcomes for clients, lease versus own, as well as comparing different lease proposals and analyzing it to advise the client as to which is the best. And it may not come down to just the face rate rent as to which is that offers the best opportunity for your client. And then finally, it's CI 104. It delves deeper into the investment analysis and helps quantify risk better and leveraging the CCIM analytical tools to help in decision making. Our Central Canada chapter, we cover an area from the Manitoba border all the way to Newfoundland, Labrador. In 2013, we had 75 members. We organize core courses as well as hold networking, breakfast, seminars, and other general networking functions. This past year, we held 2 core courses, 2 breakfast seminars, and 2 networking events. There is a website there where we post our current events and courses as well. Upcoming, in terms of courses, we have a 104 investment analysis course scheduled for May 2014. We're just finalizing the dates with the instructor. And then we're going to be offering a 101 financial analysis class in September 2014, probably the first week in September. So watch your email and also check the website for details if you're interested in taking these courses. That concludes my remarks. I'd like to invite Gary Nuska, our membership chairman, to come up and introduce Frank.
Thanks, Greg. I've got to give you credit for getting here this morning. I know that we did sell 100 seats, and you'll notice there's some vacancy here, so I think I know why the airlines overbook to try to fill the empty seats, because they're keeping some more, and they're probably still stuck in traffic, some of the people, and they'll be coming here. And I want to thank Frank for getting here today, because we tried to throw a roadblock in for him by giving him 1,900 Don Mills, but the resources and his staff have managed to figure that out and still be here. I'm so glad about that. The last time Frank spoke in a meeting, it was at Ryerson University. They have a degree program there now, and CCIM, in affiliation with Ryerson, is supporting that program by meeting with the students, by showing the students different things that are happening with you in the industry. Literally, there's a who's who here today. If you look around the room, the people that are here that do commercial real estate, the contacts that you have are second to none. And so we invite you all to be members of the chapter as well. When we spoke, when Frank spoke, he had standing room only there. Part of the reason was because there were no chairs. But today we have basically a full audience for this group here today. Mr. Mayor was top-ranked Canadian real estate research analyst for 35 years. Bringing a wealth of research here today is very special. Recognized as such by leading independent surveys, including Brendan Wood, Starmine, and Greenwich. He has experience with both global and Canadian investment dealers, including UBS, Bunting & Warburg, HSBC Securities, and most recently, Mr. Mayor was Vice Chairman and Senior Real Estate Analyst at Desjardins Securities. His senior executive management experience has included roles as Head of Research, member of the Office of President, Chairman, and Vice Chairman. His track record includes identifying investment opportunities and themes at an early stage, often prior to other analysts and investors. He's graduated from Concordia University with a Bachelor in Commerce and from the University of Toronto with an MA in Economics. Let's give him a warm CCIM welcome to Frank.
Good morning, everybody. This reminds me of the days when I used to teach. This reminds me of the days when I used to teach at U of T. Of course, we didn't have all these technological stuff available to us then. First of all, let me thank Gary for inviting us here today. I say us because my colleague Michelle Sobrano is in the audience, and I might add we have a bunch of people back at the office supporting us in this regard. Let me start off. Oops. Is everything properly positioned? Okay, good. Vision was created in 2007. Just let me give you a little bit of background about our firm. It was created in 2007 by myself and my partner, Jeff Olin, who is not here today. Briefly, in terms of what Vision is all about, we have a real estate focus. We're looking for undervalued real estate, but the distinction that we have is that we do not necessarily buy real estate per se. We have, under our operating principles, we can in fact buy real estate, but we often and most frequently find that we can buy it cheaper in equity markets or in the capital markets, either the stock market or the bond market. And what I propose to do is highlight to you how we can do that. Now, of course, in doing so, we have to understand real estate markets, financial markets, and we'll dwell a little bit there in the course of this presentation. In terms of what we do in the stock market, we can go long, which is to buy things. We can also go short. That's one of the things you guys in the real estate trenches can't do. If you believe real estate is going down, you can't short, you have to sell. I remember in 1988 talking to Paul Whiteman, with whom I had a long-standing relationship, and of course he recently passed. And I said, Paul, things are getting pretty dicey in the office market. I think you should sell something. And he said to me, to whom? And so, you know, what we could have done, and what we are in fact doing today, is short. If we don't like the office market, we can short a publicly traded enterprise that specializes in the office market. In fact, we publicly disclosed to our investors that we're shorting Dundee REIT because it has a huge position in the Toronto office market and also in the Calgary office market, where there are signs of, developing signs of overbuilding. We take a value approach, and we will show you as we go through this presentation how we look at buying the shares or the units of real estate companies that are trading at a substantial discount. In other words, just to go ahead for a moment, if apartments in Calgary are trading at $180,000 a door, if we can buy a publicly traded apartment company effectively at $100,000 a door, that's a good deal. And I challenge you to try to do that in the marketplace. That's pretty tough to do. But we can do it through publicly traded securities, and that's one of the reasons why so far we have stuck to that area. We are primarily, though not exclusively, focused in Canada. Why focus on Canada? Well, of course, this is where we live. This is the market we know. This is where we have our contacts. And Jeff and I have been in this business combined 65 years. If you throw in the experience of the people in our office, we're around 75 years. And so over the years, you've developed quite a collection of individuals and companies and real estate investment trusts that you know and can understand very clearly. When you go beyond Canada's borders, of course, we have some skill set and some connections and some knowledge abroad as well. Jeff and I have done transactions and been involved in the United States and in England and in Israel. But then, of course, one of the problems you have when you go abroad is foreign exchange. And we've seen how, for example, in the recent weeks, being abroad would have been a good idea because the Canadian dollar has come down under the new governor of the Bank of Canada, who clearly wants to stimulate the economy by causing the dollar to go down. Let's proceed and give you a little bit of information about how we operate. In looking for undervalued real estate, we survey about 100 publicly traded real estate securities in Canada. There are about 100 names, and as to go ahead a little bit, about half those names are followed by analysts, the other half are not. In the course of our long-lived careers, we've become familiar with most of them, if not all of them, and so we try to be judicious in picking out enterprises where we can buy real estate at a big discount. We're, in effect, taking advantage of the inefficiencies of the market. We look at the balance sheet. I mean, it's great to buy real estate cheap, but if the company is going to go into bankruptcy because its financial condition is weak, obviously that's problematic. Our focus is on net asset value. We all know that some real estate assets produce cash flow, others don't. The ones that don't produce cash flow can be just as important as those that don't. We combine a top-down and a bottom-up approach. That is to say, we look at economic, financial, and real estate forces which are influencing the real estate markets, and at the same time we look at the bottom-up, we look at companies, take them apart, figure out if they're really cheap, and then see how it fits in, and when we get a congruency, when everything gels, that's when we make significant investment decisions. Some well-known people up there. One of the things we do is we make concentrated investments. You know, many mutual funds in the investment business have hundreds, literally hundreds of investments. I quite frankly don't know how the portfolio managers have time to follow them. What we do is we focus in on, when we get that congruency that I was referring to a second ago, then we say, hey, this is a good thing. And we say, these are hard to find. Let's take a substantial position. And you can see some very well-known people concur with that approach. As Warren Buffett says, wide diversification is only required when investors do not know what they're doing. Hopefully after 65, 70 years, personally I've been in this game since 1973, I think I know what I'm doing most of the time, until the market reminds me that I don't. Professor Burton Malkiel said 20 stocks should do it. He's probably right. And there's a longer quote by John Maynard Keynes that we found recently, which says basically the same thing. For an academic, he was a pretty smart investor. I heard he's made a fortune, and reading this helps me understand how he did it. A little bit more about myself. I think Gary did a good job introducing me. But I was an investment analyst specializing in real estate for 35 years. The good thing about 35 years, and it's not very much good about getting older, but the good thing about it is you get a lot of experience. You've been through cycles. You've seen different management styles, different financial approaches to real estate, high leverage, low leverage. You learn what works and what doesn't work. Since Gary said most of that before, why don't we proceed? Now, here's Jeff Olin. He's not here today, but you can see he's younger and more handsome. He's president and CEO, which means he does most of the work, and I get to enjoy the profits from his activities. Jeff is different than I. I've been monogamous to the investment business most of my career, apart from a few years teaching at University of Toronto in economics. Jeff was a real estate executive with Bramley in Olympia, New York. And if you notice the big high rise at the front, at the beginning of our presentation, he was responsible for that 72-story Interfirst Plaza building in Dallas. When the real estate business hit a rough spot in the early 90s, the real estate depression, he came into the investment business, and he and I have been together as a team since 1997, and very productive at that. We had to compete against the major banks, which of course could offer companies and REITs lines of credit, and we at Desjardins were not able to do so. This chart, you see a whole bunch of logos representing different publicly traded enterprises. Just to point out that we have had a significant role in originating many of these companies. Let me seize, for example, on Boardwalk. Sam Coleus came in to see me in 1995. He's a young, inexperienced guy with a great enthusiasm, tremendous work ethic, and an idea of consolidating the apartment business in Western Canada. He was doing a financing of $1.65 a share. We thought he was doing a great job. They were on the cusp of a transaction, the likes of which I've never seen before. For those of you who remember Section 15, it had Section 15 of financing involved, and there was rent controls and effectively, which were coming off. In any case, we liked the story. At that point in time, in December 1995, Boardwalk had 2,400 units in Calgary and Edmonton. We thought it was a great stock. We did several financing for them, raising several hundreds of millions of dollars over the next few years. And they grew over the next 30 months to 20,000 units. And the share price went from $1.65 to $24. So, you can make money in real estate through the stock market. I guess that's one point that's worth making. We repeated that experience when a former executive at Boardwalk, Sam Coleus' partner, George Reddy, who some of you might know, he moved over to become chairman and was until recently chairman of Killam Properties. And he phoned us up and he said, Frank, you got to look at Killam. And we said, what's that? Well, the reason we say what's that is that it owned something like 209 apartment units. And subsequently we had a meeting with investors, and one of the Reichman relatives stampeded out of the meeting because he says, I own more units than that. He missed the point. The point was that they were going to consolidate the apartment business in Eastern Canada. And the net result was that we led a group of investors that invested $5.7 million. They limited us at that. The Reichman family invested. Barry Reichman went on the board. 18 months later, the 50-cent stock became $2.70. As an aside, they consolidated 4 for 1. That means 4 times $2.70, which is what, $10.80. The stock today is trading at $10.25, so it hasn't gone anywhere since 2004, which is, by the way, the time we stopped doing work with them. Cause and effect? I don't know. I wanted to say about that. The long and short of it is we've had a significant role in the growth of many of these enterprises, and why that's important is that in terms of how we do our business, we're always looking for the Boardwalks and the Killams where you can get the extraordinary gains in a short period of time. Moving right along. One of the reasons why we can do well in the stock market is that not too many people, real estate professionals, like you guys, transcend the real estate side and the capital market side. They're two, even though the real estate is common to both. We're looking at real estate stocks, you're looking at real estate per se. A lot of people don't do the arbitrage. We do the arbitrage. So one of the problems is that in capital markets, because so many people don't come across and do the arbitrage, inefficiencies exist. And by inefficiencies, what we define that as shares or units prices that sell significantly below net asset value, or for that matter, significantly above. And we'll come to some specific examples of that. I'm not going to go into detail because of the time considerations as to why these inefficiencies exist. They're listed on this slide. Briefly put, analysts only cover about less than half of the 100 publicly traded names. And a lot of the companies, the analysts, follow a limited number of names. And many of our competitors do not operate as we do. As I said, we can go long, we can go short, we can do paired trades, and we can explain all that. In terms of NAV, this is by Raymond James. I thought it was by RBC. But what that tells you is how the prices on average of Canadian and American real estate shares trade relative to their NAVs. And you can see it doesn't share prices do not stay at their NAVs. They go to premiums and they go to discounts. And lately, we're at a significant discount. And of course, what's happened since May is that there's been a fear that rising interest rates would hurt the real estate industry. And that has played out. Investors have said, okay, the real estate game is over, and there's been a lot of selling in real estate shares. The premise being, and how this feeds back on you, by the way, the premise being that it'll be harder for the REITs and real estate corporations to raise money to buy the properties. And you probably noticed that real estate investment trusts and real estate corporations, the publicly traded ones in any case, have not been as aggressive competitors for properties. And they've basically pulled out of the market. And the reason is that they can't finance growth. Real estate investment trusts on average pay out 100% of their cash flow, so they, by way of dividend or distribution, so they don't have any cash left over to reinvest. And in order to get money to grow, what they need to do is do issues, and the market is not receptive currently. What we do is look for exaggerated versions, people beyond those entities which trade at even a greater discount. I saw Mr. Harper the other night. I don't know about him being a great prime minister, but boy, can he play music. He was unbelievable. He has a band, you know. But seriously, Canada has good government. We have a low amount of debt. See that Canadian flag over there? Look how low we are relative to every other country. Certainly at the federal level, we're very disciplined, and we can thank Pierre Elliott Trudeau for that, because he got the country into a mess, which we have to dig our way out from. Now we've forgotten about it, so we're thinking about bringing in his son. Good luck. If that happens, I might move somewhere. The States is not particularly attractive with Mr. Obama. Anyway, what is the key real estate statistic? Everybody used to, what's a key real estate thing? Everybody says, you ask any real estate guy, what's a key real estate? Location, location, location. I mean, everybody knows that. And I'll tell you, bullshit. Oh, this is being recorded. Take out the word bullshit. What I mean to say is employment, employment, employment. Why is employment important to real estate? Think about it. Location's important, mortgage rates are important, but what creates demand for real estate is employment. When people are employed, they need to work somewhere. They need office space, they need industrial space, they need retail space, and when they have jobs, they can afford homes, either in terms of renting a home or buying a home. But the only thing that doesn't relate to employment is retirement, and I'm facing that momentarily. So let's continue talking about employment because it's a more pleasant topic. As you can see from these charts, Canada's recovery from the Great Recession has been far superior to the United States. Our unemployment rate is considerably lower than in the United States. And it's no wonder then that our real estate markets are, for the most part, better than in the United States. Now, the American Federal Reserve has been juicing the American economy like mad, and the American economy is starting to perform better than the Canadian economy, which is probably why the Bank of Canada is letting the Canadian dollar slip down as a means of stimulating the Canadian economy going forward. One of the things that's helping us is the low tax rate. I mean, in some provinces, the corporate tax rate is 25%. Let's talk about reasons to stay in Canada. Earlier speaker mentioned immigration. Look what's going on here. If you look at the employment, the immigration to Toronto is running around the 75,000 mark, but look what's happening now, increasing portion to Western Canada. You can see that very clearly. Look at in this top panel here, look at the green line. That green line is Alberta. Can you believe, in absolute terms, Alberta, with a population that is a third of Ontario's, is getting more people? Maybe we can thank Dalton McGuinty for that. I mean, after all, Dalton, what did he give us? He closed down a bunch of plants, gas plants, lost $1 billion. He gives us kindergarten, which saddled the taxpayers with $1.5 billion every year for ad nauseum. And of course, we have an annual deficit that's huge. Thank you, Dalton McGuinty. It's not just the price of oil and the oil sands. Western Canada is being helped by the mistakes of the central, the provincial governments in central Canada. Look at the migration as a percentage of the population. Again, look at Alberta, 2.6 compared to Canada. And look at this. You know what they say, people and employment, that's the most important thing for real estate. I hate to tell you this, but we're taking reservations for the next plane to Alberta outside here as you leave. Look at this, 34% population growth. When I started my career in 1974, Calgary had around 400,000 people. Today it's 1.1 million. Edmonton similarly. Canada is doing well because of the banks. I'm not going to spend very much time there. Let's proceed to housing. If you look at the bottom panel there, you can see how Canadian housing prices have done relative to American. We all know the American housing prices have collapsed. There's a basic difference between the Canadian housing market and the American housing market. It's very simple. Americans get paid, it pays under the American tax code to lever up your home, use it as a piggy bank. In Canada, one of the few tax loopholes is to pay off your mortgage. And that's what most of us have done. I make you bet most of you don't have mortgages on your homes anymore, and you're paying it off as quickly as possible. That's what most Canadians do. The Canadian housing scene is far more solid than most external people realize. By the way, when I did some work on my PhD thesis back at the University of Toronto, the single most important statistic is when the Toronto Real Estate Board puts out the sales to listings ratio, and I probably don't need to tell you very much about it, but a sale is an offer to purchase that is accepted. It represents demand. A listing is an offer to sell a home, and it represents supply. And you seasonally adjust it because, as you know, there are tremendous seasonals, not only because of the weather, but because the real estate board shuts down around December 25th and screws up the December numbers. Look, again, tale of east-west. Look at Toronto. The sales listings ratio is a balanced market currently. Look at Calgary. Stronger. So, same story. So the employment trends that we talked about before, how do they manifest themselves? Look at that map. North of the border, single-digit vacancy rates in office industrial. Below the border, double-digit. Things are improving in the States, however. You can see how this decoupling between Canada and the United States is played out. In the upper left panel, you can see office vacancy rates in industrial, retail. Just trying to save some time here. This chart, while a little bit complex, does show you that there's been quite a development wave in Toronto and Calgary, and has led us to short Dundee, which has a significant presence in both markets. The development wave will mean that the vacancy rate could be substantial in both Calgary and Edmonton. Now, Calgary has surprised in the past because of, the dramatic absorption of space by that oil and gas industry. One of these days that won't happen, but in Toronto, as you know, there's a lot of space under development, not only downtown but in the suburbs, and this is a problem in terms of those markets. Here's the downtown areas. You can see how Toronto is really an outlier in terms of the problems there. I don't need to tell you that cap rates have mirrored the decline in interest rates for the last 20 years, really. I think it's fair to say that the decline in the secular decline in interest rates has to be coming to an end. How dramatic the bounce back will be, I don't know. It has yet really to be reflected in cap rates for downtown buildings, but for the suburbs, you can see it's starting to tick up. And I think that's generally true. I think, based upon everybody I talk to, it's the Class A properties, the demand is there from the pension funds. and that's keeping cap rates down, even though interest rates have ticked up. It's in the B and C properties where the REITs have stopped buying, and there is some upward pressure. In Calgary, the problems have been accentuated by the fact that Imperial Oil is leaving downtown and moving to the southeast. And so their absorption downtown is, as you can see, has become negative. Cap rates in Calgary mirror those in Toronto. No upward beat yet. In terms of retail, something interesting for you to think about. In Canada, we have far less square footage per person than in the United States. And as a result, sales productivity has been a lot higher. The offset to that, of course, is that a lot of American retailers are finding out that it's more expensive to operate in Canada, and therefore you need greater productivity. But until recently, there's been a huge number of American retailers coming to Canada, but the Target's experience hasn't been too pleasant, and so one wonders if that will persist into the future. Certainly, the impact of the internet is becoming recognized, and I hope there's a chart here. We're coming to it shortly, I hope. Yeah, oh, good. Here you can see vacancy rates in the residential apartment side. Vacancy rates in Canada and the rental side have been low for as long as I can remember. And part of the reason is it hasn't been economic to build. Only recently are some buildings starting to be built of it in places other than Halifax and Moncton. In fact, a lot of apartments have, as you know, been converted, and that has reduced the supply of rental apartments. And a lot of migration. People like to rent initially because they don't know whether they're going to stay, they don't know what part of the city they want to live in. You can see the vacancy rates. Look at in Alberta, where they have a freer market. Ontario, of course, believes in rent controls. Look and see what's happening here. How many of you can remember when there weren't rent controls? And you know what? The market functioned. Vacancy rates went up, builders stopped building. Vacancy rates went down, rents went up, builders started building. Governments have no faith. It's important you remember what's happening here in Edmonton and Calgary. Look at these vacancy rates. Basically, in Edmonton and Calgary today, the vacancy rate is next to zero, and is forecast to stay that way. Edmonton, similarly. And that will have some bearing on what we'll visit lately. Okay, let me say a word about technology. You can all remember back around 2000 when technology stocks were booming, that everybody said, well, what do we need real estate for anymore? Everybody's going to get everything on the internet. Well, it turned out to be a crock. I mean, it didn't happen. But it's starting to happen now. I mean, you know, Amazon made the news the other day. They're going to have drones delivering packages to you. Walmart is talking about delivering groceries to your home. You know, it's the most striking thing to me in a personal sense. I used to think I was safe in terms of, you know, shopping when my wife was at home. She wasn't at one of the shopping centers. Now I come home and she's sitting in front of the computer. I said, what are you looking at? I figure she's checking out a news site or, you know, Neiman Marcus, Saks Fifth Avenue. My daughter's got her hooked on this. And so she buys a few things, and then they start tailoring they send her promotions. You were interested in this type of stuff, so we're going to send you here's some other things you might be interested in. So now she's buying on the internet. I find that remarkable. I never thought you could buy a dress on the internet. How do you figure out if it fits? She's gotten around it. She's gotten around it. If you need a hint or two, I'll give her her number. So the point I'm making is that there was recently an analyst out of the States that made some estimates. I thought it was going to be in this presentation, and I apologize that it isn't. Who's indicated that because the percentage of sales, of retail sales, has been rising through the internet, demand for retail space is slipping, and demand for industrial space is rising. And it's not small. You're talking millions upon millions of square feet. I don't remember the actual numbers. This was for the United States, but it's real, and it's going to become more real. And you know, it's virtual space is probably the most significant competitor for real space that we've seen. The one thing, and it's self-evident, the one thing I'll tell you is that nobody's figured out yet how to live in a computer. So residential seems to be okay so far. But you know, I'm trying to make a very obvious point. Office space. You know that demand, I could put a chart up here, I didn't bring it with. The number of square feet required per employee is coming down sharply. So that means the demand for office space is being reduced. You know, you can Skype, you can teleconference, and God knows what. I mean, all these things are serving to reduce the demand for office space. The demand for retail space is being reduced by the internet. And the consequence is that of the non-residential, the only area that seems to be benefiting by these trends is industrial. Okay, so we've set the table for a very interesting discussion. At least I hope you'll find it interesting. What do we do? Here's a company that we own 10% of the shares. Now we take our investors' money very, very seriously. Why do we own 10% of this company shares? Let me first of all tell you a little bit about it. Main Street is a Calgary-based apartment company, rental apartment company, that has grown since 1998 from, has grown from around 272 units to about 8,500 units today. It's not as well known as Boardwalk that I mentioned earlier. It grows in the fashion described in that little chart in the upper right-hand corner. It buys run-down apartment buildings when the vacancies are high and the rents are relatively low. It evicts the tenants, fixes up the units, re-tenants them, refinances them at the higher value because the rents have risen and the vacancy rates have come down, and gets its money out and does it over again. I think I have an example here. Here's a value-add situation in Saskatoon. You can see very quickly what they did. They bought a building for 35, what is that? That's 35 million. Spent about 8 million for a total investment of 44. They fixed it up. You can see before and after pictures down there. They prettied it up. They refinanced it for 55 million, and they took on 11 million. They took out 11 million and proceeded to spend that 11 million to go again. Nice, eh? Here's what they do in Edmonton. Here's a building for 6 million, spent about 400,000, refinanced it. They had to leave in $790,000. Look at the returns though, and you see the before and after pictures. Now, one of the things they do, of course, is cluster. They buy these smaller buildings, they're B buildings. They're not the prominent buildings that the larger landlords like to buy. And you can see how they cluster. We'll come back to that in a minute. So here's the essence of this story. As I mentioned, it's grown very rapidly. The second panel, you can see the growth in units. On the top, on the bottom, look at the value. This company was worth around 17 million in 1998. I assure you that the new number is coming out and it'll be north of $1.1 billion. What's remarkable about this guy did it, Bob Dylan. He's not the singer. He's a Sikh immigrant. But boy, he knows what he's doing. He did it with net amount of external capital of $10 million. Net amount of external capital of $10 million. That's all he got from public investors. How? He doesn't pay a dividend, he reinvests his money, and he refinances properties in the fashion I just described. So let's see what's going on here. Here's the situation that we faced, the table at the lower right-hand side in front of you. Let's compare BEI is Boardwalk, MEQ is Main Street. So you look at, here's how we look for bargains on the stock market. Here we go shopping, looking for real estate. So, Boardwalk, trading at 41 in March 2010. The NAV at the time, according to the analyst, was 40, net asset value is $42. So it was trading at a discount of 3%. Big deal. Not a significant discount, but look at Main Street. 1061 at the time. NAV, according to the analyst, of $18. We thought they were too low. But the discount is 40%. That means I'm buying their portfolio at a 40% discount per door. My wife says we don't own enough real estate. I said, when we own shares, we own real estate. We personally own the equivalent of 81 units out of that portfolio through our personal shareholding, never mind the shareholding of Vision Capital. Now here's how everybody says, hey, you need dividends. Get dividends. Wrong. You bought dividends, you got Boardwalk, you got 65%. 65% is not bad. But if you took no dividends and you got Main Street reinvesting their money for you, it's up 198%. Almost triple Boardwalk. More than that, there's more to come. Why? Because Main Street trades at a huge discount. Remember I gave you the averages before of the discount to NAV? Well, you can see it here. The average of Canadian REITs in red is 9.9% at the time we did this chart. Look at the discount of Main Street shares. Look at the discount of Main Street shares. What happened? 20% here, based upon analysts, 27% based upon what we think, and 35% based upon what the company thinks. Why is the Main Street, so not only is Main Street still selling at a big discount, it also has very favorable real estate markets, huge in-migration into Alberta, vacancy rates of 1% or thereabouts, rent increases in the range of 5 to 6 to 7% per annum, and they still have to get the benefit. Look in Edmonton how they've clustered their holdings in the downtown area to benefit from the new arena. You see that red spot there of the new arena? The new arena is part of an attempt by the city of Edmonton to refurbish, to revitalize the downtown area. Look at how Main Street has positioned itself. Let's go to number 2, Morguard. Morguard is a big company. I mean, if you haven't heard of Main Street, I would forgive you. If you haven't heard of Morguard, I wonder if you really should be here. Morguard is a really big company. And directly and indirectly, it has around $14 billion of real estate, half of which they manage for institutions and half of which they own a significant amount. Let's skip over that. Now here's the decision that we faced in August 2010. We look at Morguard controls a REIT, MRT. The parent company is MRC. So you look at MRT, on August 10th, the one to the right is the REIT. You see it was trading at $13.59. It paid a 6.6% dividend. The NAV was $13.25, so it was actually trading at a 3% premium. We don't like paying premiums for real estate. We like buying discounts. We're cheap. Morguard shares were trading at 40. The NAV was 76, according to the one analyst that followed it. We did some work on the back of an envelope, well, a little bit better than that, and we thought the number was closer to 100. Subsequently, new accounting standards caused them to reveal the NAV was 133. So, I mean, it was trading at a discount then to the analyst number of 47%. So instead of buying the REIT with the 6.6% dividend, we bought Morguard Corp, which controls the REIT and pays a niggardly dividend, and we made a lot of money instead. So you see the REIT did okay, 51%. But it was a sucker bet. We bought the deeply discounted parent company, and it's up 200%, 4 times. So that's how we like to buy real estate. And even today, Morguard is cheap. Look at this discount. The average discount of real estate stocks in the Canadian market to their net asset value is 10%. Morguard is 44%. It's a huge company, hiding in plain sight. Now you might say, why doesn't Bay Street bring it to everybody's attention? Why? Same thing, same reason for Main Street. They don't issue shares. Therefore, Bay Street can't make money. They don't issue shares. Therefore, there's no, the commission on a share issue is 4 or 5 or 6%. They can't make money on them. Therefore, but the REIT, which pays out its cash flow, has to keep coming back to the market. There are 5 or 6 analysts following the REIT, the Morguard REIT, 1 analyst following the Corp. So it's an asymmetry in the marketplace which causes this divergence, but we can take advantage of it. How am I doing in terms of time? Gary, how much more time do I have?
Greg? We could probably go another 10 minutes.
10 minutes?
Yeah.
Okay, let me give you another example then. There's a company listed on the Toronto Stock Exchange and the New York Stock Exchange called Brookfield Residential. Brookfield Residential, for those of you that got a long memory, is basically the result of a merger between Karma, which is a land developer, publicly traded land developer in Calgary, with Coscan. Remember Coscan, which used to be Costain, and Ross Collingsworth, some of you remember the name, and they had a significant operation in Toronto, as you will remember, and significant operations down in the States. So they put them all together and called it Brookfield Residential. And here's what they own. Look at this. In Calgary and Edmonton, they own a few lots, like about 45,000. And then they also have significant holdings in California, Washington, Los Angeles, and San Diego, Austin, Denver, etc. It owns 100,000 lots. Guess what's in short supply in this recovery in housing in the United States? Lots. When everybody was getting crunched, nobody was spending money on land. And the home builders, God forbid. So, listen, this going back a few years, we thought the housing recovery was going to happen, but we weren't sure. So what did we do? We decided to buy Brookfield Residential, but short, to offset the risk that the American recovery would occur. We found a company called Tion Ranch. I remembered it was listed on the New York Stock Exchange, and I said, this would be a nice offsetting short. You see where the Tion, look on the map and you see Tion Ranch is a little bit north of Los Angeles, in fact, quite a bit north. Nice piece of land, but I mean, it's really effectively not in the Los Angeles market. So what a great short. It's not Brookfield's holdings in the Los Angeles area are far superior. So, great short. Here's what we did. And to the left of the dash line, what we did is we went long Brookfield Residential and short Tion Ranch. Effectively, we offset the American operation, and this allowed us to focus in on the profitable Canadian operation. Karma is a cash cow. It produces $180 to $200 million per year pre-tax income. Can you believe that? I mean, it's huge. The dash line represents that moment when we realized, hey, there's going to be a significant housing recovery. So what did we do? We got rid of Tion Ranch and went naked long Brookfield Residential. Well, the stock has gone since we owned it. We bought it originally at $7. It's hit $25. It's currently trading around $21 or $22 US. And the game isn't over, guys. We just had a meeting with them yesterday, 2 days ago. And I personally believe that this stock is going to $35, $40. Why? The housing recovery continues. They have what every home builder needs. Service, lots. So what we're predicting, along with the company, is that the profitability in the United States will ultimately, within the next 2 or 3 years, match the profitability in Canada. And then you'll have one hell of a profitable entity. I'm going to skip that one because we're running out of time. It's a nice, interesting story. And this is also an interesting story, but long and short of it is we've done pretty well since we started. Our longest standing fund, the Vision, I see a lot of you taking pictures of this presentation. If you come up to me or to my colleague here, Shale, and you want copies of this presentation, it might be, we might make it available to you, so save your cameras or your phones. Anyway, our longest standing fund, the Vision Opportunity Limited Partnership, is up approximately 170, this is outdated, we had a very strong this November, up around 173% compound annual rate since we started of 20%. And as a result, we've garnered all kinds of awards, and I'm not going to bore you with the details of them. Looking at this another way, here is the fund over a little under 5.5 years, 159%, as I said, it's up 173. Basically what we're arguing here is that based upon our experience, based upon our ability to recognize opportunities at an early stage, as I told you about Boardwalk and Killam, based upon our ability to take advantage of inefficiencies in the market, we should have a good absolute performance, and we should have a good relative performance. Now, how do you measure relative? You see the blue lines here in the middle here. One represents the Toronto Stock Exchange in the same period, 12%. We handsomely surpassed that. The S&P 500, a little stronger competition, 57%. And the real estate index itself, 62%, but you can see we've done better than them. And we've done better than, somebody threw us in the Scotia hedge fund index because some of our activities are considered hedge fund statistics. We've done better than them because they're negative. So we also do so with less risk. One of the ways we eliminate risk is we don't use borrowed money. We only use our own money. The entities we invest in are leveraged. That's enough. And here's the breakdown of our portfolio. You can see a heavy exposure in residential, which means rental apartments. Technology doesn't affect it, as we said before. In terms of what we do on a daily basis, I hopefully you've learned something about real estate and taking a broader perspective. Ours is a national as opposed to a Toronto perspective. It's a lot easier today to be involved in more real estate markets than the one you live in because of technology, because of the ease of travel. But one of the ways, if some of you are interested in what we do, very briefly, we have a number of funds open to investors. All of them qualify for a 4.5% annual distribution if the investors seek to have it. The details are listed there. The management fee per year is 2% or less in one specific instance. And if we do well, beyond our hurdle rate, we get 20%, and that's how effectively we operate. I should mention that while we just yesterday got a very substantial investment by a major Canadian institution. So we have significant institutional investors, but for the most part, investors are wealthy Canadians. Our minimum is $150,000. For the most part, investors do not, we offer them confidentiality. Several people have been kind enough to say, use my name. Eddie Sunshine, for example, at Riocan said, please use my name. He's been an investor since day one. Ira Gluskin, who has considerable notoriety, is also a substantial investor and has publicly stated that on BNN. You can see valuation is done by third parties. We have lots of lawyers involved, and so on. Our advisory board, Dino Chiesa used to be chairman of CMHC. Also used to run a real estate investment trust, for those that remember residential equities. Gary Goodman was Paul Reitman's right-hand man for many years, the CA. Albert Sobrano, some of you may know him, he's an entrepreneur, both in real estate and in retailing. And Adam Berkowitz is a New York-based real estate investor. And that's the story. I'm afraid I had to, because in the interest of time, cut out some parts. If in fact you want to discuss any of these matters with me or with my colleagues, feel free to do so. I don't know if there's time for questions, but let's go. Don't tell me.
Yeah, you mentioned sunshine, but you also said the REITs were going down. So, what about how does say RioCan compare to Dundee REIT? I think RioCan is mostly in retail rather than in residential.
Dundee REIT were short.
Yeah.
We are not short RioCan. Basically, we think the fundamentals affecting Dundee are more adverse than those affecting RioCan. RioCan is being run very adroitly, very smartly by the management team. Another important distinction between the two is that Dundee has an external management structure, where they get rewarded very specifically in terms of management fees and all kinds of percentage of cash flow, whereas Eddie Sunshine and his colleagues have an internal structure where they get salaries and bonuses, and therefore they're more closely aligned with investors. We prefer internally managed companies, and you'll notice that both Main Street and Morguard are internally managed. One of the things I forgot to mention, by the way, about Morguard and Main Street is that over the past 10 years, their compound annual growth rate in their NAV has been about 20% per year, and they're comparable in their share price, 20% per year. Not a bad investment for your RRSP. And by the way, of course, they're less affected by the current malaise in the markets because they reinvest most of their, or not, if not all of their cash flow. Next question. Yes, sir.
Do you pay commission if we refer client to you to buy your fund?
I beg your pardon?
Do you pay commission if we refer client to buy your fund?
Check with Mr. Sobrano, and he will clarify that matter for you. Mr. Shale Sobrano is sitting right here. He's a handsome young man. Even younger and more handsome than Jeff Olin.
Frank, can we drill down just a little bit in the example you just gave of Ed Sunshine and RioCan? In RioCan, managers are employees. They don't own shares. So how is it you see, perhaps you trust, that their interests are aligned with those of investors? Not a good question.
If you have an external management structure and your remuneration is based upon the total assets, for example, then you'll grow it as rapidly as you can, and you'll have a continual flood of shares of issues which might be dilutive. But if the manager is being rewarded by total assets, then he doesn't care. He'll just want to grow total assets. Eddie Sunshine will get rewarded not only from the growth of the enterprise, but from the growth and the profitability of the enterprise. That's the major difference. And incentives do distort. I'm reminded, I heard some Russian here earlier. I'm reminded when I studied the Russian economy of a nail factory that was given a quota in pounds or whatever they use in Russia, and they produced these big, massive nails that nobody could use. They met their quota. These, incentives can, if they're external as opposed to internal, can result in perverse results. And you have to recognize that in terms of human nature. Next.
Are you buying rental apartments only from stock market, or if, let's say, it's, I list some of them, let's say, can I offer it to them?
Okay. The answer to your question is a very direct one. Why should I buy apartments?
and pay market when I can buy Main Street today and effectively pay 2/3 of market. So if the market price for apartments in Calgary is $150,000 per door, and I can buy Main Street through the stock market at $100,000, why should I bother buying apartments, especially when Mr. Dillon will run it for me, and I don't need to worry about bed bugs, and I don't need to worry about cockroaches and rats and difficult tenants and all that stuff.
Because we get paid by trades.
The question is, if they're still available,
Which?
the opportunity to buy them. Is there still opportunity to buy them?
According to Mr. Dillon, since interest rates started to rise, there are more opportunities. Remember, he operates in Class B properties, and the Class B properties is not where CAPREIT and where Boardwalk operates. It's not the cement high-rise structures. It's the low-rise walk-up structures, or elevated. They could be elevated. And there's less competition. And since interest rates rose, he's telling me that the pipeline has expanded dramatically.
Are you looking for other Mr. Dillons at an early
Absolutely.
stage?
Absolutely.
Can you play that out for us? Would they approach you, you approach them?
You never know. You never know how it's going to happen. In the case of Boardwalk, Sam Colliers came in to see me. In the case of Mr. Dillon, one of my colleagues said, hey, you got to meet this guy, and I did. In some cases, you have people that you've known, and they phone you up and say, hey, you got to look at this. Or in other cases, you read something and you cotton onto something. And in some cases, you miss it. In many cases, that happens by accident. I mean, we got involved at Brookfield at a very early stage, and it was almost by accident. Perceptive, but by accident.
Boardwalk, particularly Main Street, they have a modest portfolio, so 200 and some odd units.
270.
But they have no experience with the public markets. Is that the case? So.
Yep, but they came public, and I presume that Bob Dillon thought he would need external capital, and then he realized it wasn't a free lunch, and he decided to make do without it. At one juncture, we did a $33 million convertible debenture for him, but in 2009, I told him, Bob, God's given you a unique opportunity to buy back your own shares at a discount, a dramatic discount. Do so, and he did, and that's why the net amount of external capital he raised in the history of this company is only $10 million.
Do you invest in commercial mortgages?
No. We primarily invest in publicly traded securities. We can and do invest from time to time in their bonds issued by publicly traded companies and or preferred shares. By the way, we are not precluded in investing in real estate directly or bonds, but so far the values are such that, and our skills are such that the advantage is to be in the publicly traded realm. I've exhausted you. Great, thank you very, very much.
Thanks a lot, Frank. I think that was very informative, and the questions were excellent. I'll just call upon Gary Nuska one more time to say a few words before we take a quick break.
One of the things we do, maybe I can ask Gary Hoffer to get to the internet. Say when? Okay, that's good. Okay, there's two things I'm going to take an opportunity here for. One of the things that we've done on ICIWorld, which is an independent company operated by me, separate from the chapter, having nothing to do with the chapter other than making a service available not only to the chapter but to the industry, to real estate boards and companies, is a service that is haves and wants, dealing in haves and wants in commercial real estate, but now because of the advent of what's happening on the internet, more in residential than ever before. And that is a have and want information service. And in return or in consideration for us promoting this particular event, spending a lot of time and energy for the last month promoting this event and teaching every one of you in many different formats, and for filming this and making it available afterwards. We're like a sponsor for a show, like Kraft might sponsor a certain show, so ICIWorld is sponsoring this particular event. And so we're producing a movie that'll come out after that you can see it, and there'll be a little commercial at the beginning, a little commercial at the end. In consideration of that, they've allowed us to do a little 2-minute commercial right now, and I'm going to tie it in with what's happening here on the internet. If I can find the mouse here. You'll notice that there's a have and want button here. I'm going to click on it, and these are haves and wants of chapter members. So in other words, if you're a chapter member and a member of ICIWorld, your haves and wants can appear. But one of the things I wanted to introduce today that's brand new, cutting edge, nobody has seen it yet because it was just developed, is something called a have and want age, the age column. About 3 or 4 months ago, we had the president of the Michigan Real Estate Board. He's also, I think it was a commercial board, I'm not sure, and also the president of the CCIM chapter. And what they did with their listings is they only allowed listings to be 30 days old. If your listing was not 30 days old, if it was longer than 30 days old, it dropped right off. You wouldn't even see it. Well, I thought about that a lot after he left, and he says, a lot of you want current information, no question about it. I've always felt that older information, the information might get old, the listings might get old, but the people are very much alive. So we make contacts with people through some of the older listings. If they're dealing in $20 and $30 million shopping centers, those people haven't gone away. The listing might be old, but the people are still there trading in real estate. So that was the benefit of older listings. But then we had one critique, area of improvement, you could say, was the newer listings. So we've now created a button that you can actually search listings in the chapter 1 month old. That's it. And if you want to search them by price, you'll see I'm going to click on all categories by price, and these listings, 85 of them are within the last 30 days. And you'll see haves and wants. And I think a lot of you like that? The fact that you've got newer listings now. I'm seeing a lot of yes heads go up because you've been asking for it or recommending it, and it's been some frustration on some people's part. Now, the default is going to be the 6 months. In other words, when you go to any of our apps, which are available to 5 billion people worldwide on your iPhones and Androids and Blackberries, if you take the 6 month one and click on by price, you'll see the difference. That there's 171 available within the last 6 months. We put the solds there because there's still important information. You might want to talk to those people. They might have other listings, and also you can talk to them about sales, etc. But I wanted to just introduce that and part of it. The second thing I wanted to cover today has to do with your membership in the CCIM chapter. You'll see that the class of people that are in this room, I think, are second to none when it comes to trading in real estate, taking an industry, and furthering your education, members of the Toronto Real Estate Board, CCIMs, and having great speakers such as we've had today, very much so. And we want to invite you to the chapter. And there's a special outside, which normally is $129, but at this event, if you leave them a credit card, it's $100 to join the chapter. And at one time we did a study that 65% of the people, members of the chapter, did business with other members of the chapter. And if you build that respect and you build up a relationship with other people in this chapter, you will find that you can do more business with people in the chapter as a result, particularly if you know of some of their haves and wants going along the way. Greg, are we taking a break or what's happening next?
Yep.
I'll let Greg take over here. Thank you.
Thanks, Gary. As on the agenda, we're going to take about a 10-minute break for networking and socializing. And then for the chapter members, we're going to have our quick little annual general meeting starting at about 10:30 as well. Thanks a lot. Sorry, one last thing.
If anybody wants some information about Vision and the way we operate, our brochure is up here.
Okay, and one last thing, we're going to do the draw for the pen that everybody put their cards in for.
Are you fed up with looking for real estate and not finding the properties you want, like apartment buildings, restaurants, even shopping centers? Visit ICIWorld.com. We have over 30,000 listings, most of which are not available on real estate boards. For the public, you can search and post ads for free and receive daily listings by email for free. For real estate agents and brokers, you can post an unlimited amount of ads, gain full access to our FSBO database, and place our revenue-generating widgets on your website, and much more, all for only $319 plus applicable taxes. From homes to apartment buildings to businesses, come to ICIWorld.com to find your next deal and to promote your properties. ICIWorld.com, real estate networking since 1994.